Let's bring in Raymond James' David Long and CFRA's Ken Leon, who this morning upgrades JPMorgan Chase from hold to buy. So actually, let's start there on the heels of earnings. Ken, why the upgrade this morning, and how does it speak to what you saw in the results today and your upbeat perspective on it?
So we think bank stock pricing, they bottomed last third quarter, and we're seeing constructive outlook. In the case of JPMorgan, it's best-in-class quality. We don't see demand destruction here, and what's likely as we get through the first quarter or so, we're actually going to see a more optimistic scenario for banks for the rest of the year. Bank of America, of course, was very different, and they're setting a lower bar where they're saying the consumer is really going to slow down spending to really low single digit. But at the same time, the results were pretty good. I know Jim Cramer has a soft spot for Wells Fargo. They were weaker than the top banks that we just mentioned. And we would stay with quality. We're just seeing in the traditional bank area healthy corporate lending. We're also seeing consumer loans and rising net interest income still benefit results. That's pretty good when you have bank stocks trading at discounts to the S&P 500.
Yeah. David, let's stick with Wells Fargo for a minute, which is down 4% right now. I mean, we knew there was going to be this $3.7 billion settlement. There was going to be a charge there in this current quarter. But the fact that the stock is trading lower, the fact that this restructuring we've been talking about for so long now still seems to be maybe, at least in some aspects, according to some estimates, falling short still. How do you see it?
Yeah, so obviously a little bit of headwinds this quarter with some of the noise, but I think I'll say I'm on Jim Cramer's side of that steak dinner bet. I'm still bullish on Wells Fargo coming out of their results here this morning. They had the asset cap in place for the last 5 years, and it forced them to really manage that balance sheet well, have a very efficient loan and deposit base, and that deposit base is proving right now to be very beneficial. They have the lowest deposit costs of the bigger banks, and as rates move higher, you're seeing them increase those deposit costs at a slower pace than their peer group right now. Also, loan growth. Loan growth has come back. Wells Fargo now is a place that bankers would like to work as they're going through their recovery. And Charlie Scharf has replaced a lot of the management teams, and there are now bankers on the street that look forward to getting a chance to help Wells Fargo become one of the powerhouses again in banking. And then on the expense side, when you compare them to their peers, expenses ran a little bit higher because of some of the noise in the home lending business this quarter. But over 2023 into 2024, they're one of the few banks that will be able to reduce core operating expenses. This is a function of the headwinds that they had, not being able to cut expenses, but also a lot of the compliance and other costs that will come out over the course of the next several years. So that's a benefit to their earnings growth prospects versus their peers as well.